This market is looking a lot like Swiss cheese lately, and I'm honestly getting sick and tired of it, but it's a good thing we at least know and can acknowledge that the market doesn't care how I feel, and therefore, now more than ever, it's incredibly important that we remain diligent, stick to the process, and build a logical game plan into the end of this week. So let's go ahead and do that now. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of tonight's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY daily time frame, what do we see here from a trend perspective? Certainly in a daily uptrend, breaking to a brand new higher high on today's session. Of course, the break was up and over here as of last week's close, the Friday session in particular, and the Thursday session of last week actually produced a daily higher low by flipping into an hourly downtrend. You can see that we did respect our daily 50 SMA and we did not dip a toe into this gap down underneath us. Now, a majority of the gains that we've tacked on this week come from the CPI gap up, and we'll talk more nuance about that on the hourly chart in just a moment, but because we're at the highest high of the sequence, we ultimately can afford some sort of higher low. In a picture perfect world, a gap fill reversal would keep us over the CPI gap close at 441, but you could still technically have some wiggle room back down to this structure around 437.35. That would not be a violation of the last higher low on the daily time frame chart. If we take out a Fibonacci sequence from the low of the overall move down here to the top, the most recent highest high we just produced on today's session, notice that the pullback structure, 437.35, is technically above your 38.2, meaning that even if we get this nasty, or seemingly nasty intraday it would be, pullback into the end of this week, there is an opportunity to classify this as bull flag consolidation on the daily time frame chart. And on the weekly chart, that would certainly look pretty darn good, holding up over this prior weekly pivot high. So pullbacks certainly welcome at this point in time, but let's briefly differentiate between looking for a risk-friendly pullback to participate in upside versus throwing shorts at the market saying, I got to short this because it's sitting on a higher high. This is far too overextended. We're through the upper edge of this week's expected move. It's been gap and go. I mean, this can't continue. There's a big difference between both of those mentalities, right? And as a matter of fact, the folks who continuously short this at the highs because they're just so convinced a pullback needs to be around the corner, those are the folks fueling the continuation in the upward direction. Anybody who's short up here usually stops out after we've produced a higher high. And what does a short do to stop out? Of course, add buying pressure to the market. So I want to be very transparent that, sure, we keep talking about looking for a risk-friendly pullback to ultimately get involved in, but it doesn't mean that the market's a short. We're not trying to take advantage of that pullback until we actually flip into an hourly downtrend. And there's nothing about the daily chart here that would suggest the bears have an overwhelming edge. As a matter of fact, it's the exact opposite. After you can clearly see there was no attempt to close the gap on the CPI session, right? So gap and go, FOMO, short squeeze, all of that is a contributing factor to the nature of how bullish this move has been in the upward direction. And then just for a little bit of irony, right? This is the Fitch credit downgrade back over here. Of course, Moody's changed their outlook from stable to negative on the AAA rating for US debt. But, you know, with that, I mean, again, ironically, that's the next target overhead. That's a gap close up and over 453.50, closes at 455.85. Kind of interesting to put it in that perspective. Let's jump on down to an hourly time frame chart and just briefly discuss how, once again, there's no indication on the hourly of the bears or sellers coming into control here. We, of course, on the hourly trend count have a higher high as well as a higher low on today's session. So we're clearly in an uptrend. There's no reason to believe that a big daily downdraft is coming around the corner until we actually flip into an hourly downtrend. And I think that the CPI gap up has actually made our job incredibly easy. Again, there's no attempt from the sellers to close that thin structure underneath us. As a matter of fact, we get a gap and go, a little bit of a strong move out of the gates there. We'll see that on the market profile in just a moment. And all of the consolidation is up and over 448.10. On today's little liquidation break session, sort of midway through the day, we look into this range and then pop back out. There's really not a lot of price acceptance today inside of that consolidation range. So what does that mean from a positioning perspective? Obviously, buyers are feeling content. Sellers, the more time we spend over 449.85, even if they have the best possible trade location, start to become on edge, right? That's really not a comfortable spot to be in if you're a new money short to this market. You ideally want to see this level break down. So what's the game plan going forward? I think it's fairly straightforward. This, of course, is bullish activity. Any price acceptance over 449 449.85, I would not want to be short this market. If we start to dip a toe into here, I would be expecting more so two-sided trade. I wouldn't go out there and short the market aggressively if we're just in this range. And the reason behind that is that you can clearly see, again, as we dip a toe inside, there was not a lower high that was produced back inside of that overall range. So all it's going to take to, again, fuel another squeeze in the upward direction is liquidation break into this range, shorts pile into the market. If we get a higher low back above, I could see the same sequence happening in the upward direction only after a higher low. So I'm not advocating clearly that this is a bullish setup, but I'm saying in the future that could fuel the fire for continuation in the upward direction. Everybody remains frustrated with the market and it just takes off like a rocket ship, right? So instead, the responsible short is looking for a trend reversal on the hourly, which in my eyes starts to unfold as you really disappoint the longs who are late to the party from the CPI gap up, right? Anybody who's a long in here, who we just illustrated was feeling pretty happy, starts to feel not so happy when and if we get a lower high underneath that consolidation at 448.10. From there, you could start to look at this as a target. Obviously, that's your Tuesday low of day. And as and if we move into the CPI gap, we certainly have an intermediate level. It's very dim on your screen, so I'll read it out loud. 443.25 is prior structure off from our left, but because this is a gap, ultimately, the gap close is the completion of that move at 441. I want to be very transparent here as well. Just like you can get a short squeeze by dipping into here and then finding a higher low back above quite quickly, if we look into the gap below, do not find acceptance and do something like this. Once again, I think that's a sucker's move to trap some shorts in here. If the shorts have not already stopped out, they will definitely stop out on a subsequent break up and over 449.85. So I would be very mindful that a partial gap close in the current market context is incredibly powerful for continuation of what feels like an overextended move. The other thing to point out, obviously, is if this gap close does happen all the way, we get consolidation here, break to the close, I would start thinking about gap fill reversal off of 441. So what does that mean? On the hourly time frame chart, just like we're looking for an hourly trend reversal here, we would look for an hourly trend reversal down here. That might begin with some sort of equal low being produced, a double bottom on the hourly time frame chart. Our other favorite pattern, everybody's favorite pattern, is of course the inverted head and shoulders. Low, lower low, higher low, break that neckline for a higher high, and now you're back in an hourly uptrend. So watching 441 quite closely, and then as we talked about on the daily, the line in the sand there would be at 437.35. Let's just briefly throw on the anchored view apps. I'm sure you could imagine that we're above all of them, all of the key anchored view apps to all the major inflection points. So gap number 1, gap number 2, this is the Friday break of last week, and the CPI gap is over here. What you'll start to notice is that into the end of the week, this anchored view app from the Friday breakout of last week will slowly provide confluence at 446.15, the beginning of the gap underneath us from CPI. If we break down through that, these will slowly start to provide confluence at the gap close of 441. So that's why those are really the primary levels to be thinking about, but the hourly trend certainly can change on a lower high underneath 448.10. If we do see upward lift, just be mindful of that Fitch credit downgrade gap overhead 453.50 up to 455.85. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, let's focus on the Tuesday session. Obviously, substantial volume inflows on the individual day, well up and over positive 300 million, closing out closer to almost double that, just shy 552 million on that individual day. Net flows on the week are sitting at around 650 million in this box right here. Remember, substantial flows cumulatively for the week are generally up and over positive 500 million or underneath negative 500 million. This certainly checks that box as well. If we're thinking about the advanced decline line, up in over correlated zone, well over our trend higher zone, which is typically between 1500 and 2000. So what this would indicate to me is that the run higher on Tuesday session is generally not sustainable to the same magnitude into the end of this week. Generally speaking, you would see digestion via sideways consolidation or some sort of pullback. If we take a look at the cumulative build out of the tick, it certainly was substantial out of the open, but it didn't really build into the afternoon. To me, again, more so of an indication that, okay, people were excited on the open. If you take a closer look at the Tuesday morning session, right, you could start to think of this as a little bit of short squeeze and then digestion into the afternoon. The cumulative tick would actually agree with that. Remember that short squeeze on the cumulative build usually looks like a sharp move higher and then a plateau. Sustained buying throughout the session really looks like a 45-degree line, and we did not get that on Tuesday. So I don't want to attribute all of Tuesday's move to short squeeze in particular, but it could have been stronger from a cumulative build perspective. If we take take a look at today's session, is a pullback coming around the corner. Again, nothing about this is bearish. This is not bearish. This is a little bit bearish out of the cumulative build, but it's certainly not like dreadful, oh my God, bears are taking control of the market here. I think we still just want to mostly be prepared for the possible change into an hourly downtrend. If you're looking at a 15-minute chart, yes, this is a 15-minute downtrend, but again, you would need to break down underneath your value area low from the ES on the Tuesday session around 45.02 to actually kick off that overall hourly downtrend and really put the gap close into play as a particular setup. So good first steps. The market's certainly cooling off. It's not nearly as bullish as it was on the Tuesday gap higher, but it's not bearish. Again, I want to be very, very clear about that. We're not just blindly fishing for shorts here. We're looking for a mild pullback to get involved in on the long side of the market. If it develops into a further pullback, if the internals really support big deterioration of the trend, that's a different story. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, what's happening with the value area and point of control from the Tuesday and Wednesday session in particular, obviously Monday is well off of the screen. Value area is overlapping to up, and the point of control also migrated higher on today's Wednesday session. However, if you look at Wednesday as an individual profile, what you'll notice here is that the value area and the point of control are fairly central. The purple line always represents halfback on my personal profile, so 50% of the day's range, quite literally at the midpoint of the distribution. The other interesting note here is that we do have a normal curve as a shape of the profile. So the trend days are not continuing here. And what this would reference is that two-sided back and forth style trade can ultimately resume in this market, or it might be more likely to resume now that we've got one day of it. All it would really take is a violation of today's low. And the reason I want to talk about today's low is because it's a mechanical low. It goes right to the point of control of the Tuesday session. So what that would indicate is only short-term momentum style buyers can see that reference point. So short-term traders, short-term buyers are still in control of the market. If we take out that low, those buyers likely have some sort of stops down here that could trigger some sort of flip into an hourly downtrend. Now, as we discussed over on the SPY chart, what we would like to see is a breakdown into this thin structure underneath us. It's really the value area low of that Tuesday session. So 42.05 is the equivalent of 448.10 over on the SPY. But if we do start to break down into these single prints of the Tuesday session, you'll notice how that technically has thin volume here, thin structure, that could be the precursor to ultimately moving into the gap range underneath us. So watching very closely into tomorrow's session, specifically Thursday, what happens at Wednesday's low of day. We've talked about why that is such an important inflection point and how the thin structure really kicks off sooner than the Tuesday low at roughly 45.02. That's the value area low here. And technically single prints begin at 44.99, 4,500 round number if you prefer nice easy figures. The last thing to point out here is that we do have a poor high on today's session, so you could start to envision some ideas that come to mind, such as a break to repair that poor high, failing back into range really kicks off a failed breakout, and then all it would take is a rotation to the low of the Wednesday session to kick off that breakdown, right? If we test that after a failed break to repair the poor high. Obviously, in the post-market session currently, we're not even close to that high, so this remains on the back burner for now, but it's something to at least carry forward. Switching gears to the QQQ daily time frame chart here, very much the same as the S&P 500. One interesting note to make here is that we've already produced an equal high now to the very top of the weekly balance range that we've been monitoring after this look below and fail over here, much closer to 352. So that trade is complete. The weekly look below and fail is now complete after achieving the top of the overall range here. Just like the S&P, we're clearly in an overall daily uptrend. The ideal structure to hold a higher low over after producing this higher high on any subsequent pullbacks would be a gap fill reversal off of the Monday high of day, 378.25, or the line in the sand closer to here at 373.50. Both of those locations are obviously well above your 38.2 coming from the bottom of the move all the way up to the most local high. Your 38.2 is actually confluence with the bottom of this 3-day range over here, a little bit closer to 370 flat. We didn't have any gap fill on today's session, so once again, Swiss cheese does exist underneath us, but remember that mentality that we just walked through over in the S&P. To start talking about upper targets, we actually have to bring this out to a multi-year chart and just point out that, remember, as the breakdown was unfolding over here, the VIX was quite elevated. So what seems like a really far and distant target at 397 is actually reasonable based on prior structure over here. If we go back over to current price, right, you can see 397 feels like it's miles and miles away to the upside, when in reality, it's still exactly what the structure might suggest. Again, understand that we are right at the upper edge of this week's expected move, so weigh the risk-reward opportunity up here. It probably would favor some sort of pullback, or a pullback at least would give us an opportunity to get involved from a risk-friendly perspective. Let's jump on down to an hourly chart here and walk through some of the same psychology and levels that we did over in the S&P. You could start to imagine how maybe these patterns turn into head and shoulders with the move higher on today's session. A little bit more of a pronounced lower high into the afternoon out of the QQQ, but nonetheless, a key line in the sand will be that breakdown point at 384.25. If you can break that on the hourly and produce lower high consolidation underneath, it's all about the gap closing to the downside. And once again, just like in the S&P, when and if we close that gap, we are looking for double bottoms, we are looking for inverted head and shoulders, we are looking for simple hammer candles down here, any indication that buyers are trying to step up around that 378.25 level. If we do break to the upside, you probably want to see, noting that we have lows, higher lows, technically equal lows here, right? So you want to see a higher low over 387.25 if you're going to continue to push your luck in the upward direction here, to at least offer some sort of risk-friendly objective or trade idea in essence, right? An entry here, stop just underneath, and as we were talking about earlier, there's a lot of room to run overhead. I'm not making the, again, please do not misunderstand, I'm not arguing that we're going to 397 in the blink of an eye, although with these market conditions, you never know technically. So we won't hold our breath on that one, but do understand you need a risk-friendly entry if you're going to continue to chase this outside of the upper edge of this week's expected move. We've talked about downside gap fill. Let's quickly throw on our anchored view apps and just get a sense for where we are from that perspective. We're above all of them over time, just like in the S&P. This might start to slowly creep up here. It would be a bit of a long shot into the end of this week for perfect confluence there. The same thing with the gap close at 378.25. So not learning a ton about that. I would say if we start spending some more time underneath, we talked about 385.60 on the pre-market live stream this morning. That would be a decent indication for that neutral back and forth style trade. It's exactly where the liquidation break went to on today's session, 384.25 we just discussed. Anything underneath that really kicks off a little bit stronger of that pullback. So really open to what happens in this gap. We don't have any prior structure like what we saw in the S&P with that level going through the middle from prior levels off to our left. So very open-minded to the QQQ testing into the gap and keeping our wits about us for the possibility of some sort of like partial gap close. And then again, if we're back over here after a partial gap close, let's just say arbitrarily that the anchored view app holds, it's a pretty decent indication that you've likely suckered in some shorts thinking that the market finally has to pull back. It needs to go to hell in a handbasket. It's going to zero. If we get the higher low back above here, it's a pretty decent indication that, okay, the short still isn't working out, and it's very likely that this turns into a balance, and into the future, we can look for a more constructive long out of that balance for continuation up towards some of those higher targets. Let's move along and take a look at the market internals for the NASDAQ side of the market. Just like the S&P, substantial inflows on Tuesday, overcorrelated on Tuesday. Cumulative build here out of the NASDAQ is actually much stronger than what we saw over in the S&P. Notice that we actually got that continued build into the close instead of pulling back and kind of going sideways into the close like the S&P. You'll also notice that the cumulative build on today's session is not nearly as aggressive in the downward direction, even though I would say the liquidation break and the 15-minute downtrend here is a little bit more severe than what we have over in the S&P market. So probably watching the NASDAQ for a pullback due to the 15-minute structure being weaker here, but what I would want to see as a complement to that, so yes, weaker structure, but probably looking for weaker internals, or at least deterioration of internals if that's going to pair nicely with the NASDAQ being the favored short instead of the S&P. Both of them still have the gap structure underneath us, so we will be watching very closely for that. Let's jump on over to the market profile for the NASDAQ, and what you'll notice over here is that this is your mechanical level. Right at this 15,870, we'll call it, 15,870, this turns into overhead supply. You can clearly see an H period due to the amount of excess over here and the thin volume that was transacted. This is liquidation break. This is not stronger sellers getting involved in the market. This is longs with terrible location, not getting much price acceptance outside of or above the prior high of day, saying, you know what, we're going to throw in the towel, everybody stops out. But again, where does it go? Kind of right to a very interesting point over here. We support right off of that major inflection point we just described over on the QQQ market, right? So as long as we're over that level, I don't think it's worth throwing in the towel yet. You would want to be patient, really look for two-sided trade. Similar comments to the S&P with the value area being overlapping to up. The point of control is only mildly higher out of the NASDAQ side of things. We do have a lack of material excess high up at the top as well. So keeping a very open mind. The key levels to watch from a profile perspective would be the prior point of control and where the single prints begin. That's at that 15,870. Goodness, I can't see with that orange tag here. 15,870, and the low of today's session much closer to 15,830. 333, which in the QQQ, as we were just describing over here, is going to be your 384.25. So we've got the level squared away. Let's move along into the small caps. So all you can say about a move like this is just wow. I mean, about a 4 sigma move at the peak highs of today's session, reaching into that daily 200 SMA. I mean, we know that small caps are generally more sensitive to economic data, hence the CPI move in the upward direction, but a full rotation up to 181 coming from way down here at 170 roughly, I think that was off the bingo card for a majority of folks out there. So it wouldn't be unreasonable to see some sort of pullback here, especially noting the daily structure of today's bar, large inverted hammer, large upper wick, again rejecting that daily 200 SMA after a little bit of a test at the highs on that initial run up this morning. So a pullback, a very classic setup, right, is underneath the low of an inverted hammer, should bring you closer towards the retest of this prior high at 175.25, which is incredibly important because that level is basically the neckline of your inverted head and shoulders from a weekly trend reversal point of view. You don't even have to think of it from a pattern perspective, right, but that would keep us over our daily 50 SMA, and it would leave the CPI gap unfilled, indicating the strength of the buyers if we could see them step up on the retest of that prior high once again at 175.25. The reason that this is so substantial is because remember that small caps generally lag a market cycle. Intraday, they can act as a leader and push and pull on the market, especially when the NASDAQ and the Russell are opposing each other. They're divergent. But in terms of a major cycle in the market, small caps are generally seen as a more risky asset class, and thus they're bought into after things have sort of stabilized out. So if this is playing catch up, it does strike me as a healthy rotation to sustain more of a bullish move across the broad market indexes as a whole. Now, before we get overly optimistic, right, let's just go back to a weekly time frame chart and illustrate that, sure, it definitely looks good and there are some subtle improvements on the daily time frame chart, but we only find ourselves in the midpoint of this overall weekly range, so we don't want to jump the gun. Of course, to be more confident in that broad-based rotation, the broadening nature of the market rally, you really want to be over 200 in small caps, undoing this entire downdraft that we've seen over the last couple of months. So good first steps, but there's still a lot of work to be done out of small caps in particular. So we'll keep that at the forefront of our mind before we get overly bullish on the potential rotation theory there. If we take a look at the IWM on an hourly time frame chart, I think it just makes our levels incredibly clear. You can see the give back that took place on today's session. If you break down underneath the breakout point from the Tuesday session, basically those consolidation highs, 177.75, the doors open through this thin structure to retest the top of the gap and your prior high here at 175.25, as we were just discussing. Not much else to go on aside from that. If we do move into the gap, obviously we'll take that in stride underneath 174.20, closes down at 169.75. If we do get consolidation up here, obviously that would be the most bullish outcome, but it wouldn't be top of mind in particular. Let's just jump on with a Fibonacci here from the low of the move up to the high, because we are getting beautiful confluence with the 38.2 right at that pullback level we're concerned with, between 175.25 and the top of the gap there at 174.20. Last but not least, before we move into the market internals, will be the anchored view apps. And I just want to illustrate how it's been a complete reversal. Switch the script, right? Notice how here we're underneath all of the major anchored view apps, and now we're above all the major anchored view apps. So there's a major change in tone here out of small caps, which once again is worth paying attention to. As long as it can continue, it would speak to the broadening nature of the market rally. I think that this speaks nicely with confluence here, 177.75, and over time, these three will be clustered around our higher low zone, 175.25 down to 174.20, as we were just referring to. Let's jump on over to the market internals for the Russell side of things. Certainly substantial inflows on Tuesday, overcorrelated on Tuesday, and in terms of the cumulative read, we did get a little bit of that uptick, just like the NASDAQ, into the afternoon session. On today's session, though, what you'll notice specifically with the cumulative build is that it's much more bearish than what we saw over on the S&P and the NASDAQ. So it doesn't strike me as being unreasonable for small caps to pull back, especially noting the daily inverted hammer and give back that we can clearly see here on the hourly time frame chart. So being highly attentive to 177.75, and obviously if that does pull back, it would make you cautious and potentially looking for an hourly trend change over on the S&P and the NASDAQ as well. Let's briefly take a look at our market profile for the Russell. What you'll notice here is that on today's session, the value area and point of control are certainly lower overall, and they were slammed up towards the highs on the Tuesday session. So this, as a general inflection point, will be important. Are we inside of today's range? Are we moving into the lower value area? And then the last thing to point out is that these single prints could technically be the precursor or another level to be paying attention to before a deeper pullback towards the top of that gap. The level here is around 1785, and your rough equivalent would be around 176.50 in the IWM cash. So let's continue to peel back the layers of the market by looking at the weekly performance of the S&P sectors. Leading the pack here is real estate, up 5.57% on the week. As we know, extremely rate sensitive, but also a very lightweight sector, so it's not going to mean a whole lot for sustaining this market rally over here. Don't get me wrong, upward pressure is upward pressure, but it's not a heavyweight component. The XLY, consumer discretionary, is certainly a much heavier weighted component, up 4.39%. Really nice to see that at the top of the list. That is a risk-on indication. Materials, XLB, is also extremely lightweight, so again, it's certainly helpful upward pressure, but it's not enough to sustain a stronger market rotation. It's also worth pointing out here, everything is green from a weekly standpoint, so it's nice to see financials up towards the top of the list. Utilities, you're getting a little bit more towards the center. At the bottom of the barrel, here's healthcare. That is a heavyweight sector, but it's also D for defensive. It's nice to see it at the bottom as the market's making a rotation higher here. Energy, lightweight sector. XLK, heaviest weight risk on style sector. The tech sector, only up about, just shy of 2% there. It's not the end of the world here, and the reason being is that the structural chart really tells the story. So posture does not concern me in terms of a big bearish rotation to give back everything that we've had going on here. Let's take a look at real estate, and here we go, right? So although it's up at the top of the list, is it up here? Is it trading out above 38? The answer is no. So it's not technically leading the market rally in the upward direction. Consumer discretionary broke to a major higher high, right? This from an inverted head and shoulders perspective, or even just this from a weekly inflection point perspective. Strong recapture over this flat top with the CPI gap up. So clearly, going forward, the buyers made a substantial stride. If there is a pullback, any sort of higher low wants to be above 163.25. Watching that quite closely. Obviously, the most bullish indication would just be consolidation here and a break to continue in the upward direction, but really, really loving the recapture of this weekly level. That does strike me as an important nuance. Here's the XLB, lighter weight sector. Is it leading? The answer is no. It looks more similar to the XLY, honestly, breaking out over this flat top, but inverted hammer, it wouldn't be the end of the world if this pulled back. It's really not going to have too much impact on the broad market as a whole. Here's the financial sector, another one that's dramatically improved after the CPI print. Here's your weekly inflection point. Ahead of the CPI print, we were tangled up around it, as well as your daily 250 SMA, green and blue respectively. CPI gap up puts us away from that tangled up midpoint, strong recapture of the weekly level, and we're attempting to make an equal high closer to 35. Once again, the story here is that any higher low pullbacks certainly look good and constructive as long as we're above 33.65. So loving what we're seeing here out of financials, definitely a heavier weight risk on style sector. Here's utilities, D for defensive and lightweight. Is it leading by any stretch of the imagination? Not really. It's produced an equal high here. Certainly got a little bit of the gap love on that Tuesday session, but nothing to really write home about, especially noting in the context of just undoing this big weekly waterfall, right? We've retraced that move, and now we're sort of stabilizing and going sideways. We're not trading out here north of the daily 200 SMA. So not a risk-off indication from that outperformance perspective. Here is industrials, and you'll notice that this is up and over your double bottom neckline, if you will, from a weekly perspective here. Strikes me as constructive on any higher lows over 103.75, helpful for the bull case. Here's communications. Here's where things continue to look interesting, right? This is a balance range. This gap up from CPI puts us out of the balance range. So we had a look below and fail. We completed that trade. The next trade is a break of the balance range. Typically what we're looking for is a doubling of that range, and the range double overhead brings us to a target at 71.25. Double inside bar, two-day range is what I should say. If we break up and over 69.90, continue to put the bullish pressure on the market, pulling back, not the end of the world, as long as we hold over the top of the range at 68.10. Looking pretty good from a risk-on posture perspective. Here's the XLP consumer staples, right? This is a classic lightweight D for defensive sector, and although, yes, it is breaking to a substantial new higher high, it's still underneath this massive weekly inflection point. So I'm not seeing any leadership issues out of something like consumer staples. Here's the tech sector, right? All-time highs. We just printed a brand new one on today's session. It's hard to say anything bearish about this chart, going from look below and fail to breaking the top of the range. The measured move, just to do a quick eyeball test, right? If the range is going to double, just based on a quick, little measured move here, is just shy of 190. We're talking about roughly 188. So there's some continuation that could take place here. Any higher low pullbacks ideally want to stay over 175.70. Bullish force for the broad market there. Here's the XLE energy sector, classically a lightweight sector. It's not doing anything impressive. It's trying to resolve this weekly inflection point here with the inverted hammer, with the possibility of a daily lower high after a lower low. I wouldn't be surprised to see this one pull back, but because of its lightweight nature, it doesn't really have what it takes to end or stop a major market rally here. XLV healthcare sector, D for defensive, but as we know, the caveat is that it's the second heaviest weighted sector by market cap. What you'll notice is that it's attempting to get back over its weekly inflection point. So I like the opportunity here for a higher low. Because it's defensive, we don't want to see it leading the rally up here, but we also don't want to see it falling off of a cliff. So I'd really like to see the rotation continue, and this is sort of the same idea as small caps, right? As tech maybe takes a break, pulls back a little bit, if the XLV wants to break out over 129 and get into this previous range, that would be a helpful force for rotation and keep the market more so bullish than bearish. Let's take a brief glance at the SMH. Let's include that with our S&P Sectors, and it's basically the same thing, right? Breaking to a brand new all-time high on today's session. We did pull back to close that gap, staying over 161. That's about as picture perfect as it gets. If we do pull back further, I'd be very mindful of the gap close to the Friday high of day from last week, around 157.50. Obviously, that's a clear daily high or low. You could even pull back to here, your prior pivot high around 152.25, and still produce a daily high or low. So sectors and SMH do strike me as bullish for the broad market. Here is the ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, we're still seeing high degrees of concentration for outperformance in the tech sector, specifically breaking this flat top and continuing to consolidate on these higher highs. So you'll notice that the XLV is underperforming. That's a decent indication, right? It's not a risk-off rotation. Same thing here with the XLP, same thing with the XLU. But ideally, financials get into gear here up and over a now flattened out 50 SMA on the relative chart. Same thing with the XLY. Don't get me wrong, more progress being made here in the XLY with clean indications of a trend, not so much just consolidation like what we have in financials. So a big break of outperformance, I should say, in financials would certainly be more helpful for broadening the nature of this market rally in the upward direction, watching that sector quite closely. If the XLK ratio does pull back, you really don't want to see a lower low underneath this flat top. So we're not even close to that yet, but we are monitoring that if it starts to unfold from that point of view. Here's the XLK over the SHY, clear outperformance, printing a brand new higher high, breaking to a higher high. It would speak to a bullish divergence for the market. Once again, the nature here is a risk on rotation. This is not a risk off counter trend move in the context of a sort of downtrend, right? That's kind of over at this point. XLK over the XLU, same idea, breaking to a higher high, much more of a risk on indication. And even our apples to apples comparison with the XLY over the XLP is up towards the top of the range. Now it would be ideal if we could break this and hold higher lows now over this 2.38. Don't get too hung up on 2.38. It's kind of arbitrary here, but ideally just seeing the ratio print a higher high and holding higher lows would be good to get out of this range that we've been trading in, much more of a risk on indication for the broad market as a whole. Let's jump on over to the dollar. Massive breakdown on the CPI release, clearly moving back down into this as a monthly range. The high and tight consolidation is no longer, and it's even on the heels of a slightly lower high. At first, there was the threat of this turning into a look below and fail, but clearly with the CPI report, that is off the table. So the next major thing to be thinking about here is if we do get some sort of support off of this, a continued lower high anywhere underneath 105.65 keeps upward pressure on equities down below. The gold contract's kind of neutral on this point. It's not really suggesting much, just consolidating in the midpoint of this as an overall range. So there's not much to read into from that point of view. Let's jump on over to the TNX and see what's going on with interest rates. So as I zoom in here, what you'll notice is that on Tuesday when the CPI comes out, obviously rates tank, but on today's session, they're actually ticking back higher. I wouldn't call it unchanged, but certainly not as aggressive of a breakdown as you may have imagined considering the reaction from equities down below. So if this can get up and over the right shoulder of this as a head and shoulders, if we start taking this out, I would tend to think of this as a weekly hold of this 43.33 area. And just as a reminder, that's coming from, if we just grab a little bit more time here, it's coming from your prior inflection point top over here. So a weekly can certainly get a break, retest high or low, and then continue up towards that 5%, or heaven forbid, 5.3 out of the 10-year. So I'm just keeping an open mind to rates and the opportunity for, okay, it's going to fake everybody out if we start taking out that right shoulder. It would, to me, seem as though 5% could be right back around the corner. What's the inverted ZT have to say about the Fed? The Fed, or at least the market's belief, is that the Fed is absolutely done. It's over. No more rate hikes. Going to start aggressively thinking about rate cuts, and this is kind of the breakdown that we're seeing on the Tuesday session. session, following up and staying underneath this inflection point here. Remember, in there is a complete pause. This starts to edge on maybe one more hike. Underneath here is aggressive cuts. We don't want aggressive cuts. Let's take a look at the tracker tool now and talk about why. So no surprises out of the tracker tool here. If anything, it's really just more so amazing that back-to-back the market's pricing in 100% probabilities with certainty, not a shred of doubt in the market's mind that, hey, we're higher for longer for at least the next 2 meetings, very likely the next 3 meetings here with 75% in the March timeframe of 2024. The next major thing to start thinking about is the actual pace of rate cuts into 2024. As of right now, seeing them gradual, 125 basis point cut, hang out there for 2 months, another 25 basis point cut, 2 months, so on and so forth. That's a decent indication that the Fed has sort of accomplished the goal on the inflation front, and now they're trying to ease rates to ensure that they can maximize employment as well, the second part of their dual mandate. The issue arises when you notice that the Fed tracker tool is pricing in something like a 75 basis point rate cut. That's like, okay, the Fed over-tightened, something is likely going to break. The only saving grace is that, hey, we're actually starting from a decently elevated Fed funds rate. It would be a totally lost game if we were starting from the lower effective bound at 0 to 25 basis points. So I will give some credit where credit is due. Nice job, Powell, getting us up here in the first place, giving yourself some leeway to cut in the potential future. Let's jump on over to our calendar out of Forex Factory and really describe why the move has unfolded the way it has. It's because the market's seeing the war against inflation, if you will, as over. CPI came in lighter than the expectations, and PPI, the precursor to CPI, came in flat on the core and at negative 0.5% on the non-core PPI. Remember that PPI is producer price index. They pass along their costs to consumers, and if PPI is coming down, it's very likely that the next month's CPI will also be in the downward direction. So watching that quite closely, but again, the market's indication here is that, hey, inflation is sort of a non-issue anymore. The Fed's battle is over there. Now it's all about maximum employment, and we will be getting data on that tomorrow morning at 8:30. Unemployment claims, as always. The last thing to point out here is that retail sales weren't horrible. Core retail sales at 0.1%. You did see a little bit of a contraction in the non-core sector, but if you look at manufacturing, notice that this came back positive from a negative read on the forecast as well as the prior. So this kind of ties in nicely. If we just take a look at the GDP tracker from the Atlanta Fed, we're seeing inflation moderate, but we're not seeing it actually deflate. We're not seeing negative growth here. And that's, the Atlanta Fed has been very, very accurate with their GDP Now forecasts, even better than the blue chip consensus. Remember, the last one was almost spot on with the well outsized beat of GDP in Q3. So watching that quite closely, the last thing to point out from the CPI point of view is that medical care services, remember that we were expecting the October reset of insurance premiums, it really didn't cause any uptick. It was basically flat over here. And instead, if you look at shelter, which is over here, it was a halving of shelter inflation. Now, I don't want anybody to get it twisted. We had this argument this morning. It's not that your rent will decrease. It's that your rent is not going to go up as aggressively on the month-over-month read, right? If you're re-signing a lease and it's been a year, it shouldn't go up as aggressively as it has in the past. This is a decent sign, noting that shelter inflation makes up a substantial part of the CPI print. So that's, in my eyes, a majority of why the downtick actually took place on this morning's, or Tuesday morning session, I should say. Let's take a look at the earnings calendar. Not much to write home about over here. Target gapped up, but Cisco is going to be opening on very likely a gap down into the end of this week. Tomorrow morning, Walmart earnings are interesting, as are Applied Materials from a chip making perspective. With that said, let's take a look at risk appetite. So the TLT ratio to the S&P is still underneath the resistance trend line here. It is starting to go sideways and flatten out, though. If it does break that resistance trend line, just remember that it's more so of a concern when credit spreads in particular are widening. And if we take a look at credit spreads, they are certainly tightening. They're moving in the downward direction, which is more healthy for a sustained move in the upward direction out of equities. It would sort of reduce the risk of a credit event, if you will. This did get a small uptick on today's session out of the shorter term credit spread over here, so keeping a close eye on that. But for the most part, the unwinding of this move over here is certainly more risk on as opposed to risk off. Let's take a look at bonds in relationship to themselves, and what you'll notice is that we're starting downtrends here with lower highs and lower lows, but we're not firmly underneath those upward sloping 50 SMAs. It would be better if we could get more firmly away from them, and that would be an indication that the market is having some preference for longer dated risk assets. And the longest dated risk asset, as we know, riskiest of them all, especially in relationship to bonds, is growth stocks, tech sector to be specific. specific, right? And as we know, heaviest weighted component of the S&P, so on and so forth. So to see these make new downtrends is constructive for a stronger move higher out of equities down below. So good green shoots happening in bonds over here. Let's jump on over to the HYG in isolation because this played catch up. It did produce a higher high out of the HYG with the CPI gap up after being divergent, producing these lower highs. So we're back to even here. Notice though, the HYG pulled back on today's session or into the end of what we have currently, whereas the S&P is certainly sideways. So this would align with a pullback not being unreasonable out of something in the S&P equities down below. So watching that quite closely to see if it unfolds. Let's take a look at Bitcoin very quickly and see what's happening over here. Still up at the top of the breakout, certainly speaks to better risk appetite for financial products. Now let's move along and take a look at breadth. New highs versus lows certainly made an uptick here. It's back to positive. That's noteworthy and really plays nicely with the idea of rotation that we were describing over in IWM small caps. As long as this can stay positive, it's a great green shoot, which would speak to the broadening nature of the market rally. Other similar data points are, of course, your SPX A200R making a substantial stride to the 50% mark. That is a bullish indication, stronger risk appetite, right? Same thing with the SPX A50R, stocks trading over the 50 SMA, breaking to a new higher high with your daily chart down below. Once again, no divergences here. That is healthier for broad market and again, bullish participation taking place. Let's jump along and take a look at the RSP equal weight S&P, breaking away from this 140, which was the bottom of this range over here, the equivalent of the monthly higher low zone that we've really cared about. If we could get over 145.75, that would be like rainbows and butterflies, but like one step at a time. Certainly, this is helpful from, again, a breadth perspective here. Similar story over on the QQQE, equal weight NASDAQ, right? Breaking back up and over this flat data point and also recapturing the resistance trendline, breaking to a higher high from here to here. So broadening nature of the rally is everywhere in the S&P stocks as well as the NASDAQ stocks as of right now. One place that it's not as clear is certainly over in the Dow, if I could find it in the list. That's Bitcoin. We want to go to the Dow. Too many things here. Dow certainly produced in the industrials a big higher high, whereas notice the transports technically produced an equal high. One little caveat is that we finally recaptured this low that led to a major breakdown here, whereas industrials did that long ago. So a big, I shouldn't call it big, but a small rather, improvement, still work to be done out of the Dow component from our market. Let's jump on over to some volatility indications. VIX remains floored around that 15 point, nothing to really write home about over here. That is comfortable for continued bullish rotation in the market. VVIX, volatility of the volatility index, kind of in the comfort zone, not floored in complacency zone at 75. So good to go from that point of view. And we did just update our VIX futures considering that the contract expired today. So of course, this is a little bit skewed right now, but we know we've been working into a deeper contango for quite some time now, nowhere near backwardation. Similar story here in 9 versus 30-day VIX, and the 1-day VIX remains underneath its balance for the most part as well. Again, all of these indications are comfortable for a stronger rotation or just bullish nature of the market to continue as volatility is a non-issue. Apple is up first on the chopping block for the core list of companies, and what you'll notice throughout this section is many of these charts are in similar circumstances, so I know that I'll sound like a broken record, all right? But let's go over the numbers here and the structure. In Apple, overall, the daily line in the sand for a higher low pullback wants to remain over this prior pivot top at 180.150. If we start getting underneath that, the trend is not so clear. Today did produce an inverted hammer. If we start getting more price acceptance underneath 188, there is a thin structural retracement down towards 185. If we do continue to stay over 188, the gap close overhead is at 190.65, and then your next structural target comes from here at 192.15. Here it is on the hourly time frame chart, just to illustrate that underneath 188, you've really got a void of price action, more particularly underneath Tuesday's low to the top of Monday's bear flag consolidation range at that 185 zone we were just describing. Let's move along and take a look at Microsoft. Microsoft, new all-time highs. So the name of the game here is, in a picture-perfect world, we just hold up over that previous all-time high on any pullbacks or consolidation. The number is 364.25. Today's back-to-back, it's sort of indecisive doji on today's session, but certainly on Tuesday, a hammer after closing the gap. Here it is on the hourly time frame chart. There's not much to do on the short side here. Again, basically a brand new all-time high on today's session. No reason to be a short here until we get a lower high underneath to start to illustrate some sort of, maybe it's a man ray or just head and shoulders, right? You want that lower high underneath the prior all-time high at 364.25 before thinking about aggressive shorts, and then your thinner thinner structure breakdown is likely on the loss of 360.50, right? Flat, area of support, breakdown underneath, pretty clear rotation towards this area at 354.50. Next up, what do we see out of Google, right? Google is inside of the gap, an inside bar on today's session, little 2-day balance unfolding over a 50 SMA. If we can take out the top, higher lows over 135, continue to close the earnings cycle gap down at 137.50. If we are underneath the 2-day lows and break the 50 SMA, looking for the gap close underneath at 132.50. On the hourly time frame chart, obviously, we are in an hourly uptrend here, breaking down from this range, but catching for a higher low here. Definitely bullish on that rotation back into the 2-day balance on a higher low over 133.33 for the rotation to the top, right? So this is a higher low potentially on the daily time frame chart. I would not be a new money short up against 132.50. You're shorting into prior rejections, which can now act as potential demand, right? Let's move along and take a look at Amazon. What's going on with Nancy? Big bearish engulfer on today's session, but right to the top of the range. So again, if we're making this argument that, okay, we're looking for risk-friendly pullbacks to get involved in, this is a good first step. Now on the daily bar, we saw a perfect red solid bodied bar. Do you just want to buy that blindly? Probably not. But any sort of hourly trend reversals that are holding on to the top of this prior range, that's exactly what we've been asking for. So we have to stand by our word, our system, which is looking for an hourly trend reversal here to trade back up towards this would be a target, 145.50, 147, and then beyond that, 150 is a target. If you notice that the hourly downtrend continues by producing a lower low, then a lower high here, the next target to the downside to trade either as a short or potentially look for pullback support is at 140.50. Next up, let's take a look at NVIDIA. Everybody should mark their calendars for November 21st. It will be the equivalent of a market holiday with NVIDIA reporting earnings. Today, bearish engulfer opening on a gap up near the all-time high. No hold of that level, closing a lot of the structure underneath us into that 484.50. So again, just like Amazon, if we're asking for daily higher lows, this is a good first step. So we're basically looking for where's the pullback by. As of right now, if we can hold this, again, the same concept. If this turns into a double bottom, great. We're looking for longs right back up to that all-time high area. If we break down through it, the next major watch is down here at 469.75. How do you trade that as a short? Well, okay, a breakdown and then a 5-minute lower high underneath your neckline of this as an inverted, or sorry, not inverted, but regular head and shoulders. That's your short, right? Stop here, enter here, and then looking for the target down below through some of this thin structure. So you can trade it both ways, but again, if we're asking for a daily higher low pullback, if the daily trend is clearly up, I'm going to start thinking about that as and if pullbacks start to unfold. So NVIDIA is one of those names. Let's take a look at Meta. What's going on with Meta? Same idea with the pullback into this prior high. 329 is the area to watch. You can see in the lower wick of today's session. Here it is on the hourly. Buyers did start to step up there at your previous break, retest higher low. You want to see that act as a daily higher low now. So to get involved in this one, potentially a flat top breakout after a higher low is valid for looking for a higher high in the sequence over 338. Your next target is 347.50 in the upward direction. Here's Tesla. Let's back it out to a daily time frame chart, breaking from this balance range down here, closing this gap overhead. A little bit of a rejection around that 50 SMA, not unreasonable for a little bit of a pullback over here. If we take a look at the hourly chart, you can clearly see the inflection points that we care about, right? This 242.25, if we're underneath, you could slip that for a retest of the top of the gap, Tuesday's low over here. That would be a bearish rotation. Consolidation in here is bullish until proven otherwise. Then higher lows over 246.25 are certainly continuation worthy in the upward direction. Noting again, the big note here is that we're breaking from this as a daily range, right? This, if you will, is sort of this very, very loose double bottom or over the neckline, so on and so forth. So it is a trend reversal on the daily after printing this higher high, either looking for consolidation, break higher low, or if we break here, you ideally want to see buyers step up towards this gap area underneath us from the CPI move. 230.65, 224 is the close. Last but certainly not least is Netflix. We have a big overhead gap here. Just wanted to point that out because I will lose track. It's been so long since we've traded these prices. I don't want to mistake that for a new all-time high. We have a gap over 481.75, closes at 506.60. So just be mindful of that. This as well is a gap from an earnings cycle. What was it? Two cycles ago. Earnings, we have over 462.25, closes at 470.50. Obviously holding this prior high on any pullbacks. Looks incredible. But as of right now, solid green body bar closed. There's no reason to believe that shorts are really building any control here. As a matter of fact, this flat top is looking pretty decent for a continuation to close that gap overhead. The shorts only have an edge if we start to build out lower high here. And as I'm sure you can all sort of project already, there is your head and shoulders breakdown underneath the neckline. You get a bearish rotation for a daily higher low attempt again at 437. That's a flat top on your daily time frame chart in this area over here. From a measured move perspective, right? If you just kind of stack this on top, the gap close is the measured move of that as a bull flag. All right, 4 trade ideas, and then you are on your way. Lenar is up first on the chopping block, inside bar on today's session, back-to-back inverted hammers with larger upper wicks and a gap underneath to potentially close. If we need shorts, this is looking pretty darn good with no structure underneath us. The gap closes at 123. This is kicked off underneath 126.75. If we're just consolidating up here, treat it for what it is. It's high and tight consolidation. Would not really be a fan of trying to get ahead of the game there on a short. So please wait for the trigger before that actually unfolds as a valid setup. Next up, Uber, 3-bar play in the upward direction. Let's take a look here. There's your inside bar today over 54.20. What do we have as a potential target? Did we map one out? I don't think so. So let's do it together. Jump out to a 4-year chart. What do we have over the top here? Very interesting. The origin of this breakdown is roughly at 59. Let's go 59 as a nice round number. You guys know the rules. Rule number 2 up here in the penthouse in particular. It's a little bit of a stretch, especially coming on the heels of this sort of rally in here. I just keep this one on watch, right? It technically could consolidate. It could cool off a little bit, but you're looking for a repeat basically of what you saw back here. If we just zoom in on this segment of the chart, there we go. I know that's pretty sloppy. But if we take a look, there's your 3-bar setup, right? And we get continuation. So 3-bar setup over the inside bar high, 54.20, sort of kicks off some range in the upward direction. Just monitoring that for day trade scalps on the bull side of the market there if we need some longs. Next up, ARM is back at its IPO opening print. So from the chip making perspective, it didn't really do well on earnings, obviously, but we're back at that dreaded IPO open print. So anybody who bought it as soon as it listed, they are likely, like you can already see that they sold, like get me out of this thing, get me out for flat. You can only knock on the door so many times before ultimately you get some sort of break. And just noting that we have incredibly thin structure back on the initial IPO days, I'd just be watching that 56.10 inflection point. There's the possibility of a long trade unfolding as long as we can break over the listing price and then remain above the listing price. It's a very, very, very simple stop, right? You would just place your stop underneath. You want to maintain price acceptance over that particular level. Last but certainly not least is GM, a little bit on the cheaper side for us. But let's take a closer look over here. Probably wouldn't look to do this with options. I mean, you could, but you'd have to take quite a few of them. But regardless, another 3-bar play in the upward direction. The difference between this and Uber, obviously, is that this is happening on a potential weekly double bottom low. So instead of being extended, searching for it at the top, you're basically looking for it near the lows. If you get a break of the container bar high up and over 28.40, the target is 29, the inflection point from here. Then your next target would be the neckline of the weekly double bottom closer to 30. Here it is on the hourly time frame chart. You can see that these areas are thin structure. So it makes it attractive, less resistance to sort of battle up through as in if this breakout is going to unfold. So you've got some longs, you've got some shorts, and that is going to do it for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. As always, we will be live at 8:15 as we are every single day for the pre-market prep. Hope to see you up in the penthouse. And with that said, I wish you a green trading week.